Good day to all of you, depending on where you are. Could be afternoon, evening. And when you catch this, I am Doug Lennox with Adam Recker, the real star of this show, the guy that actually knows about money. I know about human behavior. We'll talk about me every now and then. I am the chief of staff at the Mather Group, also the founder of Think to Perform. We are a behavioral company, so we do a lot of work in what's called behavioral finance. Adam Recker is himself a brilliant financial mind. He's a CFA, he's a CFP. He and I share that designation. I also have the behavioral financial advisor designation. So he's a CFA, the most difficult initials to capture in this industry. So we know we're dealing with a lot of smarts. And today we're going to talk a little bit about what's going on. This is live, by the way. And so if you have questions, you can send them in the chat box, and we can entertain some of those questions throughout. But Adam, let's lean into it and talk about, markets move, so do emotions, and inflation's a thing. Let's start there and see what happens. Let's see see what we see.
Sure. So just kind of recapping where we are. I've been doing this the last couple of months just to give a current snapshot of things that, as the slide says, are driving investors to react. Topically today, the most recent data point, we had the Fed minutes released, finally seeing what their decision is, cut rates or not. The decision is maintain where we are, maintain the status quo, and they'll revisit again in September. Why that's interesting is it's an important factor that is driving markets and decisions out there. Looking at the data, especially over the past 12 months, we can see a couple things. For one, inflation remains more or less under control, still below 3%, which from one perspective would be a potential reason to cut rates, make sure the economy stays on solid footing. However, we are not cutting rates because, as the Fed chair has said, they're still concerned about the potential inflationary effects of tariffs. And so one of the things that kind of bears repeating is a lot of this information doesn't immediately filter through the economy. It takes a while. And so because the economy has still held up relatively well, GDP numbers came in well, they figure it's probably best to play it safe, wait a little bit longer, and don't take steps that could drive inflation much higher. As that pertains to rates themselves, when we look at something like a 2-year treasury, rates have actually fallen a bit, arguably in preparation of an expected rate cut. Again, hasn't materialized yet, but investing is a forward-looking exercise, and market participants are expecting some sort of cut early before year end. Same time, some other conflicting information potentially. We have, we look at rates like the 10-year treasury rate and even longer term rates. Those rates have generally gone up. Now, why is that? Again, could be speaking to the potential risk of higher inflation in the future, or even doubts and concerns around the U.S. fiscal situation where the prospect of owning U.S. debt may not be as attractive, and therefore demand a higher rate for owning those bonds. And so given all of that, there's a lot of information for investors to be processing. It can create a lot of uncertainty. And as we see, uncertainty can lead to different behaviors from investors.
Well, in fact, really, when we get down to it, and one of the things that we're trying to do at the Mather Group and what we do for our clients is we deal with the truth. And you just broke the big word. Uncertainty is the truth. And what we do extremely well is prepare people for the truth. We don't know what's going to happen, but we do know how to get ready for what can happen, because something will happen. So if we get ready for the things that can happen, then when something happens, if we need to put our hands on some money, there will be a smart place to get it. And the whole idea is to not misbehave in the meantime. So not let those emotions get the best of us. And most people feel better if they know right? I'll ask all of our viewers and listeners right now, if you knew for sure that no matter what happens, if you needed to put your hands on some money, there would be a smart place to get it. Would that help you feel a little better? And typical answer to that is, yeah, I'd feel a little less stress if that was the case. But we don't know what's going to happen. But I know, Adam, you and your team are especially good at positioning ourselves that you're dealing with the probabilities. And if the other thing happens, we're ready for it. So,
Yep.
so I like it.
Yeah.
So that's inflation. The fear and greed index, you talk about uncertainty, also brings about, depending on how one is feeling, I can be getting really greedy or I can getting really scared. This we've introduced this little index before, so comment on where we're at today.
Yeah, it's kind of interesting too, and actually taking a look at this didn't occur to me until just now. It's interesting that there isn't much neutrality. Really, it's a matter of swinging between fear and greed most often. And so, as we can see right now, we're actually leaning closer towards the greed, the extreme greed sort of side of the spectrum. A big reason for that has been markets have been strong despite all that uncertainty. We've had some turmoil. And actually, if you go to the next slide, it speaks to it maybe a little bit better. When we were looking at some of the tariff related issues, we had periods where we're in extreme fear. That's when the drawdowns happened. But once, we kind of realized, or, some of the initial decisions were walked back or postponed, didn't fully take effect, there was a bit of a sigh of relief, and people kind of continued on with the expectation that markets would do well because that's what's happened over the past couple of years. And so very quickly went from fear to greed again. US recovered. International markets have been incredibly strong this year, which benefited a diversified investor. And so risk taking has continued to be rewarded up until this point. But of course, we want to be looking towards the future and entertaining the fact that times aren't always going to be good. And so as we go through the conversation today, we want to kind of share things regarding the outlook, how other pullbacks have happened throughout history, and which ones should probably be taken more seriously than others. But we'll get to that in due course.
It's interesting and I love your choice of words for a whole host of reasons. They're very meaningful, but you mentioned fear and greed and the oscillation between those on the greed index. A colleague, friend of mine, wrote the book Beyond Greed and Fear, and and it's an interesting read, and it's worth it. His name is Hersh Shefrin. He also, by the way, for those who wonder, do companies make similar kinds of decisions for similar kinds of reasons? The answer to that is yes, because companies actually are led by people who have emotions just like people who don't run companies. And so his book, Behavioral Corporate Finance, speaks to how this very same stuff happens within organizations. And I imagine, Adam, you see that how organizations are behaving, certain organizations are responding more to that greed and fear index than others. Would you care to comment on that as it relates to not just individuals, but organizations?
Yeah, if you look at underlying economic reports, they often comment on what they're thinking and what they're feeling. And as there's more uncertainty, that has knock-on effects. They may postpone hiring, have large capital expenditures to build out their facilities, buy equipment, you name it. They may even raise prices prematurely in anticipation of future inflation. And so not just the underlying investor or consumer, but the companies themselves are constantly confronted with making these decisions because, end of the day, we're all human as well. We all feel the same.
Exactly right. And one of the things we want to be sure we recognize, and this, by the way, is true for the most analytical of us. Human beings are emotional beings. We cannot not be. We can try to mitigate against our emotions overriding our good rational judgment, but that's not easy to do. And that's why we use tools what we'll talk about a little bit. One, just keep in mind, viewers, we're going to talk about it. Call the 4 R's. If I don't mention it again, send it in the questions. Hey, you were going to talk about the 4 R's. But let's talk about how everybody's feeling now. What's sentiment nowadays? Let's take a look at that.
Again, just throw a little bit more confusion into the mix. One side of the coin, we have extreme greed. That's the way people are actually acting and positioning and investing. But at the same time, there's other reports that show there is concern. I mean, consumer sentiment right now has been very low. I think during our last market commentary, the data points were worse than what we saw during the lows of the COVID related period. Now, kind of a caveat is, some of it may be losing meaning because as we've seen over the past couple of years, last couple of presidential cycles, a lot of it is becoming increasingly partisan, which drives a little bit of noise because you constantly have about half the people who are upset about something. And so still
Yeah.
an interesting data point because has been some predictive value where when the readings get particularly low, it can be more of a contrary indicator that there can be a bit of a recovery or run up in the market. But again, it's something that's worth watching, and it's clear that there is still quite a bit of concern out there. Then on the next slide, maybe just to keep on elaborating a little bit further, it's important to bear repeating that there's always going to be a reason to worry. And this will be important considering many of the data points here aren't necessarily economic events. And we've had more in recent memory where, looking at the conflict in the Middle East, even when the U.S. Had a strike on Iran, there were geopolitical events that were taking place that did not move markets. And there may be a reason for that. But the fact that it did not move is actually a good thing. Because as we'll show later, a lot of these geopolitical events, the negative headlines that we are bombarded with on a daily basis, because they're addictive. It's, you see the headlines, you will read them. It turns out that often they aren't impactful from an economic perspective. And so we'll have some data on that as well. But a big part of this, again, as we know, Doug, is just reflecting and making sure not to react immediately to all the different stimuli that are headed our way on a daily basis.
Well, you mentioned the word, I'm going to bring it up now. You mentioned the word reflecting, and earlier we talked about recognizing, and I mentioned this tool that we use at the Mather Group. It's called the 4 R's, and it's really starts with recognizing what's going on, and then the reflection part is number two. And so when we can recognize, and one of the things that we realize in dealing with money, our relationship with money as human beings has a very lot to do with how well we manage our emotions. That's the deal. So how well we do that is really critical. And so one of the things that we want to be aware of is our emotional state. And so all of us that are in this program right now, everybody can practice starting to pay more attention to themselves by playing what Adam, you call, I call, I've named it, and so you've come to know the name, the freeze game. You hit the pause button, and investors, I want you to practice this seriously. Practice makes permanent. Hit the pause button multiple times every day, and you ask yourself these questions. What am I thinking right now? How am I feeling emotionally right now? And physically, what am I doing right now? And could I be doing anything better or thinking anything better? And I see Warren Buffett. By the way, I had somebody just clicked in on a message on Warren. Warren, I don't know Warren well. I had the good occasion to meet with him sit by him, meet with him. That's an overstatement. But we were at the same meeting together at American Express, and Warren Buffett is known to have said, the markets are the world's way of transferring wealth from the irrational to the rational. And what each of us are better off knowing are our emotional state. Am I in a state where my chances of being irrational are higher? And if I am, that's not a good time to make a decision. So we play the freeze game. That's the first R. Recognize, what am I thinking? How am I feeling? What am I doing? And you get bigger on that. The second part of the second R is to reflect, and if I recognize I'm emotionally charged, either really excited or really scared. The greed and fear of things are starting. If I can feel it, like, oh, I can't lose, or oh God, I can't win. If I can start feeling that, I now know I'm in the moment I don't want to decide. Now I go to the second R, which is reflect. Reflect on what? Reflect on the big picture. Oh, I forgot. The Mather Group prepared me for this moment. I'm actually ready for this. I don't have to panic. I don't have to do anything. I could, if I wanted to, take advantage of this moment. That's what Warren would do. If he's got some free cash, whatever it happens to be. That's the reflection. The third is to reframe. I'm going to change my thinking. I quote Winnie the Pooh. Winnie the Pooh wanted to change it. He didn't like the shirt he had on. So he looked down and he decided to change his mind so he wouldn't have to change his shirt. That's what we're talking about here. I was going to bail out of the market, but upon reflection, I decided to hang in there because I've talked with my wealth advisor and she told me that we're in pretty good shape here. We're in great shape. If I need money, there's a smart place to get it. So my response is to hang tight. I'm just walking through an example of how we deal with this wall of worry. And that's it. So that's my 4 R's. Impromptu right off the top, but it kind of deals with how would you add to that, Adam, with what I just said? Because I know you've used the 4 R's in your own personal life.
Yeah, I think it's obviously like everybody working through it, but I think just pausing and reflecting is very important because there's all the noise. And so I want to kind of tie it back even to the question, just because I want to not leave it outstanding. But like a single data point, for example, should not be the sole decider of a decision that's made. There's a lot more context that goes into it. They're useful. They have to be acknowledged. Something like the Buffett indicator clearly has a pretty good track record, but nothing is perfect. And the bigger uncertainty with a lot of it, as with any sort of valuation metric, is it's not useful from a timing perspective. It may help set expectations around what potential outcomes and results could be, but it won't tell us when that's going to happen. Like it won't tell us when a downturn is going to happen.
Right.
And so you have to, again, we entertain the possible outcomes, but it might inform us to say, well, maybe we don't own just the S&P 500. We'll still own it, but that's not the only thing, because there are other things that may be more attractively priced, but also not guaranteed to perform well tomorrow. But by having more of that diversified risk appropriate mix, we can get to a position where whether the market is good or bad, there's ups and downs, we can ride it out. Because as we'll see here shortly, having the wrong timing and making a misstep due to a single indicator or an emotional decision can really derail a plan, when really just riding it out and taking advantage of more proactive steps to add value is actually a better result in the end, a better approach in the end.
Yeah, well, I like how you described that. And this talks about, we've got a slide on investor traps. And those of you that study behavioral finance, you see some of these things, loss aversion, and this is really true in life in general. And Adam mentioned, when you see negative news, it attracts pain, negative news. It is human. It's a bigger attractor of our attention. It always has been, and it's very biological, has a lot to do with our survival. We want to live, and that's part of it. And then this confirmation bias. We like information all of us are prone to this. We might think I'm not like this, I'm very objective. But even look at your cable viewing habits. Do you know what programs and or stations literally to watch that reflect your point of view? And and it's that kind of thing. We have biases, and it's good to know that we do, and we're frequently looking for data that confirms our position. And because there's always good news and bad news, we can always find some of that data. Would you agree with that, Adam? It's kind of like your wall of worry. If you want to worry about something, there's something here on the wall.
Absolutely. It's there's a lot of opinions out there, and it's entirely possible you'll find one that matches yours. So,
Yeah, that's right. All right. And then we talked about this a little bit, but these are always things to caution, but people sometimes miss the rebound, and one of my former colleagues, who's an investment guru and name's Ted Truscott, and he once said, and I quoted him in my book, Financial Intelligence, he says, the thing about investing is when you have the price, you don't have the proof. And when you have the proof, you don't have the price. And everybody's wrong at the turn. I'm pretty close to exactly quoting him, but it's hard to get it exactly right. And what you're saying here is missing the rebound could be expensive. Comment on that.
absolutely. It's because some of the best days happen during the most painful periods, and just so maybe another example we put together on the next slide might actually kind of tell the story a little bit more because it goes through sort of the path of how people think and react to the markets. And so, just for quick overview, what we have here, the top line, the one that has a higher return, and then I guess the green line at the bottom, those respectively are the world stock index going back to 2016, a little bit before that actually, and diversified U.S. bond index at the bottom. We just wanted to look at like what's the experience of a 60/40 world stock bond investor. And as we can see, there's ups and downs. We had ups and downs during COVID, 2022 pullback, tariff related issues, et cetera. And when we look at an investor who just rebalances, stays the course, the return ended up being something around 7% annualized over that period. Again, for illustrative purposes. However, the experience, the day-to-day ins and outs can be very different. As you're approaching that 2020 period, and then there's a sell-off again. COVID was very unsettling for many people. We don't know where the bottom is. And so the risk is saying, well, we've fallen. I want to stop. I want to maintain what I have. I don't want to lose money. That whole loss aversion factor. You
Yeah.
sell out towards the bottom and say, I'm going to wait for the market to recover until there's more clarity. Well, then it was a quick recovery. A few months later, you're back at all-time highs. I'll get back in the market now.
Yeah.
Ride it up some more. There is a downturn again. Don't want to lose my money. Sell after I'm down a little bit, say a normal 10% correction. Wait for more clarity. And once you're back closer to the all-time highs, it feels safer. Get back in and continue that path, through the ups and downs. That resulted in about a 3% return. And that's exactly the reason why investors, often underperform their investments. The investments don't have the feelings. They don't have a view on the future.
No.
They just perform. And so we want to make sure we're in a position where we aren't becoming that 3%. We're doing things proactively to control risk, but earn closer to that rate that you get by riding out the storm.
Yeah. Well, and people will hear me say this frequently. You just said it. I liked how you gave a lot of context to it. But investments tend to work better than investors. Investments work, investors don't. And Adam said the reason why is investments are not impacted by emotions. The investors in the investment are. And so that's the difference. And so we need to mitigate against that. And that's where behavioral coaching comes in. For those of you who follow Vanguard, Vanguard is telling investors you should have a behavioral coach because they can be worth a couple hundred basis points to you net of fees so that you get what Adam is just talking about. You don't misbehave because we mostly behave our way out of the returns we could have gotten. And I thought you said that extremely well. So, by the way, for those of you that have an interest, there's an organization that we look at. It's a outside organization. It's a kind of, I call it a watchdog. It's called DALBAR. It's all capital letters. It's DALBAR. But they have what they call a quantitative analysis of investor behavior. So anything that sounds that sophisticated has to be pretty sophisticated. Quantitative analysis of investor behavior. And basically what it points out is that over every measurable period of time, 1 year, 3, 5, 10, 15, 20, the data will say repeatedly that the collective investors worked less well than the investments. And of course, what we want to do is help people not be that group that works less well than their investments. And Adam and his team and the advisors that support them make that all happen. So we've only got 5 minutes left, but let's get to these behavioral tools. We talked about one already. We hit it where we talked about pause. You've mentioned it. You talked about pause and then reflecting, and that's really right there, by the way, in that pause square, if you want to call it that. That's where we're thinking you get right into your 4 R's, because the rest of it takes you there. But how would you look at this being being a CFA? I'll talk about how I look at it as a BFA. How do you look at it?
Yeah, and this might pivot or go on to the next slide here in a second. But with the pausing, I like to think about, where are we and what reasonably can happen, and in the context of history, like how do I set expectations and then prepare for those potential outcomes, both good and bad, and know and contextualize which environments should I respond to versus not. And so, if we can get to it in a second, I'll elaborate a little bit further.
Okay. Well, we can, because here you see what we talk about, just some behavioral tools. And you should be your advisor, who's at the end of this chain, will have helped you think about this before you begin the chain. So as we support your development as investors, our job is to continue to provide you the education so that you can use these behavioral tools to manage yourself. And when you manage yourself better, your relationships with people around you and your relationships with money will improve. So the advisor will be helping you understand you should be pausing, reconnecting to the plan. That's in the reflection process. Just write it down, talk to your advisor. All of these are things that one can do to help them get back into engaging the prefrontal cortex. So with that, case studies, do you have time to cover a little bit of this, Adam? I think we're...
Yeah, I can go through it real quickly. It's just another added data point to kind of show how we contextualize. And so thought it was worth sharing. The Cliff Notes version here is certain environments have certain effects. And so as I talked about geopolitical issues earlier, that falls more under that non-economic bucket. And cutting to interpretation, non-economic events have quick moves, both up and down. And they can be fairly severe moves where it can be a big drawdown, but also a very big recovery. Those pullbacks and drawdowns and movements are so quick, it is best not to respond to them, because in the long run, they don't have that much of an effect. And encouragingly, in the most recent geopolitical environments, there really wasn't much of a response, which may tell us that investors are starting to get acclimated to that and learning. The more concerning things are pullbacks we have not dealt with in a while. And so they're more macro related, around growth issues or fundamental issues where maybe stocks become more expensive over time and can't sustain those valuations. Those can catch you off guard because they are, they can be longer drawdowns where they're slower and steadier and catch you off guard before it feels like it's almost too late. And that's when panic sets in, and the recoveries can be longer too. And so we just share that because there are certain things that can impact the drawdowns Most importantly, we want to be prepared for those longer drawdowns and have a plan because that's not so much noise. That becomes a little bit more structural. We still have to write it out for the most part, and there are things we can do, but we do not want our behavior and attention to be hijacked by things that are not economic, that don't have a long lasting effect, especially.
And that says it really well as we wrap it up, because what we want to do is help all of our clients make sure that when they need money, there's a smart place to get it. And so all of this is happening, and we're helping plan it. These are some of the anchors. And Adam spoke well about both diversification and rebalancing. You also, one of the things that one can do to improve alpha is tax strategy. These are things that we can do that doesn't require the market to do anything, just requires us to not be dumb with our taxes. And so tax strategy is a big place to gain alpha. And so are some of the other things, and cash flow planning being one of those. We don't want to ever be out of cash. Because when we are, then that's like being in the desert and we just drank the last of our water. That cash is still necessary. Anything you want to say in goodbyes, Adam?
No, I think that's great. I mean, obviously, it's not about takeaways, not about smarting the market. It's about having a system and making good decisions and knowing ourselves so we can make good decisions. People are going to make mistakes, but learning from them is important and not compounding mistakes. And so, and again, I guess the last bullet point, it's even when we say ride out the storm, it doesn't mean we're not doing anything. There are still
No.
proactive steps we
Yes.
can take, but we do
Yes.
not react in an emotional manner is the most important thing.
That is such a important thing. This is not buy and hold. This is buy and be smart. When you
Mhm.
need money, take it from a smart place, and we're going to help you do that. And always be focused on what really matters. We're going to pay attention to your values, what matters most to you, so that you can live a fulfilling life. Thank you for joining us.